Nearly every market crash follows the same exact pattern. Researchers analyzed over 1,000 market crashes going back to 1692. That's over 300 years of financial catastrophes. And they found something remarkable. Every single crash was accompanied by a narrative that made it feel like this time is different. In this video, I explain a pattern that becomes abundantly clear when you look at over 1,000 crashes. And be sure to stick around to the end because I'll share 3 simple things you can do right now to save yourself from painful losses in the future. What I'm about to show you isn't about getting rich quick. It's about not sabotaging yourself when your portfolio is down 20 to 30% and every headline is screaming that the world is ending. If this video sounds like something you need to hear, then hit that like button right now. It tells me to make more deep dive videos like this in the future. By the way, I'm Steve Reitmeister. I've spent more than 40 years investing, with over 25 years building quantitative models analyzing stocks. First as the editor-in-chief at Zacks Investment Research, now as a partner at WallStreetZen.com, where we've built the Zen Ratings quantitative model. Okay, let's get into it. Over 300 years of market crashes. That includes the 1720 South Sea Bubble, the famed 1929 Great Depression, the Black Monday in 1987, the 2008 financial crisis, and most recently the 2020 COVID crash. What do all these things have in common? Well, each has a unique, terrifying story, whether that be wars, pandemics, technological bubbles, political chaos, and the like. But here's what the data actually shows about which investors made money and which lost their shirt during these crashes. And it has nothing to do with timing the bottom. Let's start with the single most important fact about market crashes. Every crash that didn't involve a complete government overthrow eventually recovered. Not most, not some, but every single one. Okay, markets bounce back, and they're doing it faster than ever. It took 25 years for markets to recover from the devastating effects of the Great Depression in 1929. But it only took 4 years after the 2008 financial crisis to bounce back, only 6 months after COVID-19, and then most recently, when we think about the April 2025 tariff turmoil, right, and the 20% sell-off that took place, that was barely a blip on the radar before the stock market recovered. Now, researchers track 1,032 crashes across 101 different country stock markets going back to 1692. That's a very broad-based study. And here's what's wild. Despite 2 world wars, a Great Depression, multiple pandemics, nuclear scares, and the rise and fall of empires, well, global stocks still delivered roughly 5% real returns per year for over 200 years, thus significantly outperforming other asset classes. Even when you include the Russian Revolution, where investors lost basically everything, and the Chinese Communist takeover, where markets closed permanently, the data still shows broad-based resilience. Now, here's where it gets interesting for you and me. Stock returns are negative in about 25% of the years analyzed. This means that roughly every 4 years, you're going to see some red, and bigger crashes of more than 20% happen regularly enough that you'll see several in your investing lifetime. So the question isn't, will there be another crash? The question is, what separates the investors who get destroyed from the ones who get rich during the crashes? And the answer is not what you might think. Let me tell you about the most powerful force in investing. It's not compound interest. It's not diversification. It's not about riding the next great growth trend. Robert Shiller, the Yale economist who won the Nobel Prize for his work on bubbles, discovered something fascinating about crashes. He studied the narratives that accompany major economic events and found they all follow the same pattern. You have fact plus emotion plus human interest equals a story that overrides all logic. Let me explain how powerful this is. Let's go back to 1920. World War I just ended. The Spanish flu killed 50 million people. Race riots in the street, communist revolution in Russia, stock market cratering. The false narrative. The American economic system is collapsing. Obviously not true. Now we go into early 1900s. 40 countries with active stock exchanges. A golden age of global investing. Then World War I. Protectionism, tariffs, some markets closed forever. The false narrative. Globalization is dead. Most recently, the global trade war, economists warning about tariffs, market volatility, the new false narrative. This time is different. Notice the pattern. Every crash has a unique cause. Every crash has a terrifying story. And every story makes investors do the same thing. They sell at the bottom. Because here's what Shiller discovered. Narratives don't change the facts. They change how we interpret or perceive those facts. When you're watching your portfolio bleed red with the news screaming about economic collapse, your brain isn't processing the probabilities in a rational fashion. It's processing the story, which is almost always, get out now. Okay. But the data. across 330 years, and over 1,000 market crashes says something completely different. If you find this research valuable, then please hit that subscribe button. That's because I publish data-driven investing content like this every week that focuses on what actually works to help you outperform the market. And trust me, what I'm about to show you next is something most investors never figure out. Here's the paradox that destroys most portfolios. When stock prices crash, what happens to expected future returns? Well, they actually go up. That's because stocks are now cheaper. The math clearly shows that future returns should go higher as the market crashes. But what actually happens to investor expectations? What goes on in their mind? They think that the outlook goes down. People become more pessimistic exactly when they should become more optimistic. It's like standing in front of a burning building. Someone shows his statistics. Hey, 99% of building fires get put out. Real estate prices recover within 10 years. Don't worry about it. Would you pull out your checkbook and buy that burning building? And the answer is, of course not, because your eyes are watching the flames in real time. The panic and peril is real. Okay, here's where this gets really dangerous. Selling feels like one decision, but it's actually two. Okay, decision number one, when do I get out? Decision number two, when do I get back in? And that second decision is the real killer of most portfolios. The COVID crash of March 2000 is a prime example. The market fell 34% in just 23 days. Shockingly fast, shockingly scary. If you sold at the bottom, when did you buy back? Well, when cases started dropping in May of that year, well, you already missed 30% upside in the rally. Or maybe you waited until there was a vaccine, which was announced in November. Well, by then you already missed 60% gain. This is why amateur investors consistently underperform the market. Not because they can't pick stocks, but because they can't pick when to be in the market. So how do you solve this problem? You need a system that works when you're terrified. Not a magic formula, not a perfect market timing model, rather a framework based upon what actually predicts future stock performance. After analyzing decades of data, we found 4 factors that clearly separate the winners from the losers. And here's the key. You need all 4 in your favor, not just one of them. So let's pay attention to all 4. Think of it like hiring somebody. You wouldn't hire based upon just only one positive credential. You want multiple positives in their favor, proving that they are the right choice, the right person to hire. Okay, it's the same logic with stocks. Things like financial strength. Can this company survive a market crash? Growth. Is this company growing consistently? Value. Am I paying a fair price, or is it actually even underpriced and therefore a great bargain for me? And number 4, momentum. Is this stock ready to move now? Great companies at fair prices can sit dead for years. Momentum tells us when the market is ready to recognize that value. Now, why do you think this matters? Let's think about 2022. Everyone panicked about inflation. Tech is dead. Growth is over. The S&P 500 fell 18%. Even worse, Cathie Wood's famed ARK Innovation Fund, filled with everyone's favorite growth stocks, fell 65%. All the while, our momentum strategy was up 17% on the year. Same market, same year, completely different outcome. Not because we're geniuses, but because we had a system that identified real strength while everyone else was selling based upon fear. And this matters even more right now. Mega cap and AI stocks are severely overpriced, in some ways even worse than the tech bubble of 1999. Meanwhile, small and mid-cap stocks are trading at much more reasonable valuations. That is the right play at this moment. Mike Tyson said it best. Everyone has a plan until they get punched in the mouth. Looking at past crashes is easy. Living through one is difficult. So here's your pre-fight training plan. This amounts to 3 things you should do now. Rule number 1, know your real pain threshold. Rule number 2, write your plan in calm times. Rule number 3, quality is your life raft. Okay, crashes aren't disasters. They're wealth transfers. Money moves from the panic to the prepared. When the next crash comes, and it will, you'll be on just one side of that transfer. Which side do you choose? I don't want this to be just in theory. I want you to see positive results of this preparation. November 2025 provided a perfect buy-the-dip situation with the market selling off, in particular in a lot of the AI and big tech stocks. Scary headlines everywhere. Oh, the party's over. Our momentum system flagged mispriced quality stocks, which resulted in a tremendous 1-month return of 22.6%. And let's not forget 2022 when the S&P 500 dropped 18% and the ARK Innovation Fund fell 65%, and yet our momentum strategy rose 17%. Same market, same year, same asset class. One approach followed the scary narratives, the other followed a system leading to a great result. Market crashes are not a test of intelligence. They're a test of psychology, a test of patience. Knowing the data is easy, acting on it when you're down 30% is hard. That's why systems beat emotion. That's why plans made in calm times beat decisions made in a panic. When the next crash comes, it will feel different. It will feel terrifying, and every instinct will tell you to sell now. But remember this, researchers studied over 1,000 crashes over 333 years. Every single one felt unique. Every one that didn't involve total government collapse actually recovered, right? The statistics are clear. The narratives and scary headlines are not. Crashes transfer wealth from the inpatient to the patient. You've seen the data, the traps, the system. Now it's time to act. Okay, the next thing on your to-do list should be to take advantage of this free resource. That's because I use the same Zen rating system to locate 3 stocks I believe could double in the next year. Scan the QR code or click the link in the description to get that free report now. And by the way, if you're wondering if the next crash is on the horizon, I break down exactly how to spot one in this next video.